Hello and welcome to another video on how to secure yourself financially. So what I'm gonna do here is, by looking at this section, the beginner guide to financial statement, and to make a quick recap of that. So after all, this financial statement, the financial statement show you the money. That's all what they do. So you have these balance sheets, which show what a company owns and what it owns at a fixed point in time. Okay, so what a company owns and what it owes at a fixed point in time. Income statement, how much money a company made and spent. The cash flow, the exchange of money between the company and the outside world, as well as the statement of the shareholders, which shows the change in interest over time. So the TLDR of the balance sheet, this is a snapshot of the company assets, liabilities, and shareholders' equity. The income statement, you can think of that as a set of stairs where you start at the top, and every time you go down on the stair, you make a deduction associated with that earning. And the bottom line of this, or this bottom at the bottom of the stair, you know how much money a company made or not. So typically you have is the gross revenue, and you make some deduction from money that the company doesn't expect to collect, like merchandise returns or discounts, to reach the net revenue. And from there you deduct things like the cost of sales, operating expense, amortization and depreciation, as well as the interest or income interest, money that you lend or that you borrow, and the income tax payable. So with that, all right, you reach at the bottom line of this statement and show you if a company made a profit or not. And the cash flow report the company inflow and outflow of cash over a period of time. It reviews some information from the balance sheet and the income statements. And the bottom line of this show the net increase or decrease in cash. So this is generally made, or is the cash flow statement review the cash from one of these activities: the operating activities, financing activities, and investing activities. So the operating activities, what it does is this is the first part of the cash flow statement. It review the net income and analyze the net income from the income statement and conciliate with the total amount of cash that was used or perceived by other operating activities. The most, or in this case, for other operating activities. So most common operating activities, we have operating assets and liabilities. So operating assets such as accounts receivables, inventory, prepay expense such as premium insurance, rent, marketing, software license, office supplies, maintenance contract. And in the premium insurance you have, well, health for medical coverage, or home or vehicles, life in the event of the policyholder's death, liabilities for lawsuits, disabilities that prevent you from working, and long-term care such as nurse home care or home health care. Intangible assets, which is another most common operating assets, like patents, exclusive rights to creator of or inventors, exclusive right to inventors to manufacture and distribute and sell their inventions over a period of time. So, for example, the most common patent that changed the world, just to mention a few of them, you have maglev, this electromagnetic inductive system for stabilization and suspension for ground vehicles, issued in 1969. The GPS, the navigation system using satellites with passive ranging techniques, issued in 1973. The electronic device, as the patent called, aka iPhone, issued in 2007. Chris gene editing in 2014. Another investment or another intangible assets are copyright, where now this is exclusive rights to creator of original works to distribute and sell their inventions over a period of time, such as Netflix, Twitter, Spotify. Trademark, which are exclusive use of symbols, designs, words that uniquely identify this company. Trade secrets, which is confidential data the company used to gain competitive advantage, such as process, formulas, and customer lists, as well as the goodwill, the brand's recognitions and reputations, and customer loyalty, a customer relationship, which is another intangible asset. And when it comes to and when it comes to sorry. Yeah, and when it comes to another operating assets, such as intangible investment in affiliates, like joint ventures, equity investment, limited partnerships, as well as how do you put it, associates, cash and cash equivalents is another intangible assets, like money market funds, so which are funds that invest in very short-term debt financial products, such as bank acceptance, debt issued by banks, certificate of deposit, certificate of savings with short-term maturity, commercial paper, unsecured commercial or corporate debt, repo, this repurchase agreement, which is government debt. And then I look at the most common operating liabilities, such as accounts payable, accrued expense, income tax payable, money that the company owns to the government based on how much money they make, based on the income as the tax rate. So you have corporate tax in the US is something around 21. So corporate tax, withholding taxes, is a portion that the employer deduct from the gross employees' salaries and pays directly to the government. This is to promote the pay as you earn tax system on the US, so to fight tax evasion, and the sales tax, like state or city, county tax, VAT, value add tax, which is a tax imposed in the production on it and at every stage of the production of good and service along the supply chains, and the customer ultimately pay the full VAT, and business along the supply chains remit that portion to the tax. Excise tax, which are tax imposed on specific goods like alcohol, tobacco, gasoline, guns, and something called and also GST, the good and service, which is a tax imposed on the VAT on in place like Canada, Australia, or yeah, Canada, Australia, or India. Uh, Short-term borrowings. Okay, this is for companies to meet their financial needs or their working capital. The difference between the current assets and the current liabilities. A One of the indicator of the financial health, the company's financial health, and the short-term borrowings, examples like banks loans or line of credit, uh, corporate debt or commercial papers, uh, trade credit. Okay, what you want to renegotiate is the payment with your vendors and suppliers. Outstanding invoice. You based on the value of your outstanding invoice, you ask a loan, as well as the in a payroll advance, so money that you give to that a company gives to the employers, uh, that will be deducted in the next payday. Okay, so with that, then I also look at the uh, then I also look at the notes payable, which is an agreement between the borrower and the lender, outlines the terms and conditions of a loan. Okay, whether it's the principal, the interest, the repayment schedule. So a couple examples here, like banks loans or companies, where now a company raise funds or ask for loans to financial institutions like private equity or private firms, private lenders, or venture capitalists. Uh, mhm. Okay, here. I just wanted to recap that notes payable. Mhm. Whoa. What? Operating activities. Okay. So it's this, right? So notes payables. You have bank loans, business loans, bonds loans, whether it's a company or the government, where either line is the payment. Okay, so either line is the repayment of principal plus the interest with periodic payments. Okay, promissory note, which now is uh, issued to individuals or business between the borrower and the lender. What they create is this promissory notes. Trades payable. This is a negotiation extend payment period with your suppliers and vendors. Okay, trade payable and installment loans. Okay, so when an individual or business borrow money for purchasing assets like vehicle or equipment, so they may enter into installment loans agreement, and this agreement specifies the repayment terms, including the amount of each installment and the interest rates, making the notes payable. Mhm. Warranty obligations examples. And then I look at warranty obligation examples, right? Where here, this is obligations that a company has to pay. Obligations that a company has to pay. Oh. Obligations that a company has to pay. Okay. Uh, it is obligations that a company has to provide or to replace a defective product or fix. So, Jesus, an obligation that a company has to fix or provide a or replace a new product that is defective or doesn't meet certain quality standards. So whether it's a manufacturer warranties, software, parts, vehicles, service, contract. Okay. So with all of these examples, all right, of the most common operating assets and liabilities. Okay. So now I understand how the cash flow actually works, or the first part of the cash flow, the operating activities. Okay, the operating activities. Okay, so whether is the operating activities. Mm-hmm. The operating activities. The operating activities, right? And the most common operating activities, just operating assets and operating liabilities. Okay, And the first part of the cash flow review the income statement or the net income from the income statement and conciliate with the total amount of cash that was used or perceived from one of these operating or one of these operating activities. Okay, and then I look at the way how it does how it is done. So first it analyzes the net income from any non-cash items, so items that affect the income statement that where there is no cash involved. That's the reason why they call non-cash items. Okay, such as amortization, depreciation, stock-based compensation, and so forth. As well as look at the total amount of cash that was used or received from other operating activities. Okay, and the second part is the investing activities, where review is the cash flow from investing activities. Generally, this involve in the purchase or sale of long-term assets. Long-term assets such as intangible assets, okay, intangible assets, goodwill, property, plant, and equipment, uh, leasehold, uh, leasehold expansions like this. So leasehold improvement, okay, investment. So this is a couple example of long-term. Uh, this is example of long-term assets like this. You know, this is example of long-term assets. These are example of long-term. These are example of long-term assets like that. Okay. So, and after all, I just want to know what is the meaning of long-term assets. It's a resource owned by a company that expect to provide economic benefit for more than a year. So when you talk about long-term assets, it's an expected asset or resource. Okay, it's a resource that you own that expect to provide an economic benefits for more than a year. Okay, this is so. For example, when you invest in yourself, or when you do one thing over time, and also that's aligned to the market, meaning there's a lot of people that are interested in what you're doing. Okay, so this is a long-term investment. Okay, this is a long-term investment. This is one of the fear of most. Yeah, this is one of the fear of the vast majority of mothers, right? That you're not dedicating to something that you're not dedicating, that you're not commit to something in the long run. That's what happened. That's what happened. That you not commit yourself to something. So these long-term assets is talking about commitment, meaning is things that things that a company or you owns, research that you own, that is expected to provide economic benefit or value over time for more than 1 year. For more than 1 year. So they are typically not intended for immediate sale or consumption, but are used in the production or operation of a business. And here's some example of long-term assets. So, but at the end of the day, is to understand is the concept of long-term assets. So when I ask to now Investopedia, so long-term assets, okay, is definition right, long-term assets, okay. So investment in a company that will benefit the company for many years. You know what I mean? But it's like that. So when we talk about this long-term investment, so yeah, most of the time we talk about is uh, fixed assets, so property, plant, and equipment, uh, intangible assets, yeah, property, plant, and equipment, intangible assets, goodwill, investment, uh, mhm, investment, uh, leasehold expansions or leasehold improvement. But it's this, okay? Investment in a company that will benefit the company for many years. So long-term assets are investment in a company that will benefit the company for many years. So if you see yourself as a company or as a person of value, okay, so you must invest in things that will benefit you for many years. So for example, learning a language, learn about finance, learn accounting, learn how to talk, learn how to speak, learn also your how to improve your health, your nutrition, how to improve your sleep. Okay, these kind of things are long-term assets, man. Of course, if you see yourself as a company. But it's like that. It's investment in this. So perhaps, and again, consistency, commitment to the things. And long-term assets can include fixed assets. So change in the long term can be a sign of capital investment or liquidation. Or liquidation. Okay? Or liquidation. Liquidation. Mhm. So that's the whole point of this long-term assets, right? So long-term assets are resources that a company owns that are expected to provide economic output or value in a more than 1 year or in the long run, okay, for many years. So examples are, yeah, property, plant, equipment, intangible assets, investment, goodwill, long-term receivables. Okay, so when you borrow or when you lend money to others. Okay, so long-term receivables, leasehold improvement. So deferred charge, So this is example of this long-term assets. So in the investing activities, the cash flow is review, or the financing activities. The second part of the cash flow statement, review is the cash flow from these investing activities, and generally it involves the purchase or sale of long-term assets that or resource that a company expects to provide value or economic output in a year or more, right? For more than 1 year, such as intangible assets, trademark, patents, copyrights, goodwill, trade secrets, property, plant and equipment, also customer relationships, investments, as well as leasehold improvement. So, for example, if a company purchase a machinery, that activity is registered as a cash as an outflow, as a cash outflow, because cash was used to acquire that. However, if a company decides to sell some investment in a portfolio, this activity is registered as a cash inflow because cash was received from that. And the other is the financing activities. Financing activities from this, right? The financing activities, the third part of the cash flow statement, which review the cash flow from financing activities. So financing activities are transactions that involve the company long-term liability and equity. Okay, so financial activities are transactions or exchange that involve the company's long-term liability and ownership and equity. This activity primarily involves raising capital from investors or creditors to fund the company's operations, repay debt, or distribute profits to shareholders. Here are some examples of the financing activities. This is something important. This is the core of this, by the way. That is the core of the financing activity. Okay? So it's a transaction that involves the company's long-term liabilities and equity. So this activities primarily involve raising capital from investors or creditors to fund the company's operation, repay debt, or distribute profits to shareholders. But this activity primarily involves raising capital from investors or creditors to fund the company's operations. That's right, to fund the company's operations, repay debt, or distribute profits to shareholders. And here are some examples of financing activities. So when a company raises capital by selling shares of its common stock or preferred stocks to investors, this can occur through initial public offering, secondary offering, or private placement, issuing debt. So a company can raise funds by issuing debt instruments such as corporate bond, debentures, or notes payable. These instruments represent a promise to repay the borrowed amount with interest at a specified future date. and repaying debt. When a company makes principal payments and it is outstanding debt, including both short-term, so this is repaying debt, obtaining loans, payment of dividends, and repurchasing stocks. Repurchasing stocks. This is a self-financing. There is leasing and convertible debt. So okay, all right. Mm, mhm. Okay. So that'll be all for this video. Take care. Bye bye.